If you're like most people, you're wondering just how long this market rally can continue. Well, how about into next year?
We think the economy reaccelerates mildly into 26. So, like, we've already put out our year-end 26 targets, for example, and we've got a 7,000 midpoint target on the S&P 500, which is nicely up from today. We think the back half of this year is choppy, but we would see earnings on the S&P 500 growing from about, they're tracking about $265 in earnings today up to 290, which, doing the math, gives you solid earnings growth into next year.
That's Daryl Cronk, Chief Investment Officer at Wells Fargo Wealth and Investment Management. And in today's big interview, he makes a case that things could get choppy over the rest of the year, but that the market is well positioned to get into 2026, rallying and without a recession. He's our big interview today, but we kick things off with Chip Lupo, analyst at Wallet Hub, talking about their 2025 household debt survey, which showed that 44% of people expect their household debt to increase in the next 12 months, and which reported that a stunning number of Americans think that when they die, they're still going to be paying off their debts. Plus, Jenny Harrington, Chief Executive Officer at Gilman Hill Asset Management, the author of Dividend Investing, Dependable Income to Navigate All Market Environments, brings her equity income investing approach to this environment and the Money Life Market Call.
Off to the races.
Yes, we are off to the races indeed. Welcome to Money Life for August the 6th. I'm your host, Chuck Jaffe. Thank you so much for being here. We have a tremendous show for you today. And I love what you're getting out of this show because, well, I know that many of you like hearing from new and different voices, although we are pretty good about not having most voices on often. Like with the exception of our regulars, pretty much nobody comes on this show more than twice a year. Like the survey people might, like a guy like Chip Lupo, he's on when they're doing surveys. But when it comes to big interviews and market calls, really nobody is on more than twice a year at this point. And we're always trying to bring you new folks. So you get somebody who hasn't been on for a while, Daryl Cronk, great to chat with him. And then you get Jenny Harrington. She's making her debut in the market call, and I think you're going to really like her. And I will say now, I say it in the interview itself, she wrote this book. I was sent a copy of the book. I should have done it as a book interview. I read enough to know we could make a fun interview with it, and I just put it in a stack someplace, and it got messed up. Basically, it was here when I had the first of the floods that we had in the basement. It got moved with a stack of things so as to stay dry, and I just did not get to it until it was too late. Because we do have house rules about how often somebody can be on. We also have house rules about how close we have to be to a book's release date. So we didn't talk about her book specifically, but we do talk about dividend investing, and I suspect a lot of you are going to really like her approach. But I will also tell you, listen carefully to what she says when she talks about the differences between you and I as individual investors and her as a portfolio manager, because there is something in there that's really important. Now, we could follow that up and have other discussions about, well, maybe as an individual investor, because she talks about an advantage that we have in that we don't have to live up to an investment mandate and go, oh, it's telling us this is what the statistics have to be. So when certain things change, we can ride out stuff that she might have to sell. But you could also make the case that that discipline is good, et cetera. So it's interesting. I also hope that you took the time to check out and go back if you wanted to and compare Carly Garner's call on gold, Carly from DeCarly Trading, when we were talking technicals on yesterday's show. And we made her call on gold our promo. So you can go to moneylifeshow.com to find the specific clip I'm talking about. And then you can compare that to just about any part of the interview we did with Tom Windmill, but especially the end of the interview with Tom Windmill. At the end of that interview with Tom Windmill, he's talking about how he thinks that you could see a triple in mining stocks and big legs for gold. So we hope you understand disagreement does make a market, and you can't just go, oh, somebody said this on Money Life, let me go invest because of them. And if you were to say that, you'd want to like go, this is who said it. This is when they said it. This is what they mean. Because like Carly made it very clear what she thinks about gold, But she also made it very clear that there are plenty of times when her opinion changes, right? She talked about her own investment approach, et cetera. I thought that one was really interesting. We had a great conversation yesterday with Nick Sargent, today with Daryl Cronk, and tomorrow, Yuri and Timmer, the head of global macro for Fidelity. Does not get much bigger than that. Great things coming all the time. Even if you think it's the summer doldrums, it's never boring around here. But if you think it's boring, or you think you got ways that could make it more exciting, please don't be shy about writing. Chuck at moneylifeshow.com is how you reach me, and I would love to hear from you. I heard from my oldest daughter, Thompson, because she is starting a new job. She is a teacher, and she left the school she was with down in Raleigh, North Carolina. Both my kids live in that area. She moved to a new school there, and that means new 401k plan. And she was asking me to help with her picks. I haven't had a 401k where I'm limited by here's the choices for a while. And it was interesting to do it. And then you're making decisions that are different. So, those are the kinds of things. I know some of you probably have questions on that. And you may not think, is Money in My Life a place that I can ask those basics? Sure you can. Have you ever had to say, let me look at the funds in my 401k? I would like to buy the best funds. But if I buy the best funds that are here, I'm not going to have a good portfolio, or I'm not going to have a diversified portfolio. So how do you decide? In one case, I basically helped my daughter do this. And as I was putting together a potential asset allocation for her, well, one of the funds that I was using was decidedly more average. The other fund, the absolute best fund in the thing. And in terms of making other choices, well, I opted in talking with her to go with a target date fund for a bunch of the assets because that would get her more diversified. And it was a target date fund using a lot of the other funds that were available. So I'll let them do an asset allocation that's appropriate for a big chunk of the money. And yes, you will settle for not the top shelf performance. It would not be the fund family I would pick, but it's still going to be the right thing for her. She's still going to do well. And she also, because she's got this, the other thing that we will be doing is reinvesting the money from her old 401k, and that she will have as a self-directed IRA. So lots of interesting stuff there. But if you have questions about that stuff too, please don't be shy. Right now, you're probably questioning why I'm talking at all when we've got a great show to get to. So I'm going to stop talking. Let's get busy. Up first, it's Chip Lupo. We're talking household debt when Money Life continues right after this message.
Everything an advisor needs can be found in one award-winning newsletter. Advisor Perspectives takes the most important financial perspectives and delivers it right to your inbox. Go to advisorperspectives.com and stay informed.
Now Money Life looks at what the survey said. This is the survey said on Money Life. It's where we dig into surveys, studies, polls, any kind of research or data. It's going to help us understand what people are doing for, with, and about their money. And this is one of those polls that I think most of us want to measure up against because we are talking about the latest household debt survey, the 2025 household debt survey from WalletHub. It's just been released, and the data here, very compelling on a lot of different fronts, especially given what we have been hearing about consumers and what's been going on. We're going to dig into those numbers with Chip Lupo. He's writer and analyst at WalletHub, but you can go to wallethub.com for more information. And now that the survey is available, we've got a direct link in our show notes or on our guest page for Chip Lupo at moneylifeshow.com. Chip Lupo, it's great to have you back on Money Life.
Good to be with you, Chuck. Thank you.
Obviously, we've got consumers who have been complaining about what's going on when it comes to inflation and everything else. We have interest rates that have stayed higher for longer. It is not exactly a big surprise that people are expecting their household debt to increase in the next year. But is the increase maybe more than expected, or the number of people who are saying it more widespread than expected? How does this compare to even a year ago?
Well, Chuck, it seems to be right on par, which is kind of surprising because we found it's interesting as we're heading into back to school season where people are going to be piling on more debt. 44% of people expect their household debt to increase over the next 12 months. And 2 in 5 people say that debt is a source of conflict in their household. So this is an ongoing thing, and it doesn't seem to be any relief in sight.
when people are talking about increasing their debt, do we have an idea of what kind of debt they are increasing with? Like, as much as we hear about a housing crisis and mortgage debt's considered good debt by most people. Credit card debt considered bad debt. Is the increase because of what we're hearing when it comes to, it's harder to afford a house, so I'm taking on more debt? Or is it just I can't afford to get my bills paid without using my credit card?
Well, that's it. Yeah, credit card debt is the bad debt. That's a huge portion of people's debt. And again, this is a cycle we've been in now for several years where because inflation, wages are not keeping up with the pace of inflation, people are relying more and more on their credit cards for everyday expenses. And again, it goes back to people not paying attention to the terms or not knowing what the interest rates are. And then they find themselves in this vicious cycle of debt and trying to pay off the credit card debt. Sometimes other debt suffers, or vice versa.
More than two-thirds of your respondents say the economy's not doing as well as they thought it would be. When I read that number, I didn't see any sort of political affiliation or anything else attached to it. I am wondering, if they don't think the economy is doing as well as they thought it would, do they believe that they are doing worse? In other words, are they saying, I'm doing worse because the economy is not doing as well as I thought, or I'm where I'm at and the economy? I mean, that would maybe explain why we didn't see an increase over the last year, I guess.
Yeah, I think it's a little bit of both. I mean, people base their overall economic picture on their own bottom lines. People are looking at where they are now as to where they were 6 months, a year ago. And if it's not improved, it's basically blaming on the economy.
The flip side of this is that the studies show that for the most part, consumers are bitching, they're complaining. The soft data says sentiment stinks, but they're not stopping their spending. Did you find anything where, folks are saying, okay, I'm adding to my debt? Did anybody come out and say, I'm not adding to my debt, but I've dramatically changed how I spend?
No, not at all, Chuck. In fact, 52% of people say that if they could go back, they would still take on the same debt. It's almost like it's become sort of a new normal where debt is basically part of your lifestyle. You're just going to be perpetually in debt. And you get into that kind of a cycle, I don't think people would know what to do if they had no debt. It's this proverbial, you've heard the phrase, money burning a hole in your pocket. People just feel a need to spend. And at 52%, yeah, that's a pretty staggering number.
You guys ask people, do you expect to have debt when you die? And maybe that question was more nuanced than I make it out to be, because I could certainly see some people answering going, yeah, I bought this house later in life or whatever, and I took out a long mortgage because that made sense to me. So I'll have debt when I die. But I'm thinking we're talking about the ugly debt here, the bad debt. And more than half of Americans said yes. So do we have any insight into that question and what kind of debt and how much people will be carrying
Yeah,
till death do they part us?
yeah. I think it's leaning more to what you just said, Chuck. I think people have just piled on so much debt that it's pretty much a foregone conclusion to them. It's like, well, I mean, I've got this debt. There's no hope of me ever paying it off, so it's probably just going to be hanging around till I die. So I think it's more so the example like what you just said.
We talked about conflict and how debt is making it that people have a source of conflict in their household. And one of the things that can happen is, who's trying to pay it off? How are they trying to pay it off? What are they doing, et cetera? When these folks are
Right.
saying that they're still going to have debt when they die, is that because they can't pay it off? In other words, they are dying broke? Or is it, they're not managing their debt very well as they get older?
That seems to be the case that they're simply not managing their debt as they grow older. And again, this is all part of that same vicious cycle we just spoke of, where people are just taking on more debt, putting more debt on the credit cards because, and even if not only with wages, but if you're on a fixed income, inflation's certainly not keeping pace with that. So people are relying more and more on credit cards for that also. So they're reaching a point to where, yeah, I don't see any scenario in which I would ever get this paid off before I die.
You guys have been doing this survey for a while. How much has it changed over longer stretches of time?
Well, as long as I've been following the study, it seems to be incrementally higher every year, but these numbers seem to be somewhat consistent, maybe not as high or low, but the numbers have, as long as I've been following, have been pretty consistent in terms of the amount of debt, how much debt is affecting them, because we do have a stat here that talks about how debt affects people's health. 47% of Americans think their household debt's affecting their health, and that number's been consistent in all the years that the debt levels have been rising.
If debt is affecting your health, like with any of this, is the question asked, what are you doing to make this better? Because obviously there's some percentage of the population that they're not that worried about debt. They don't have it. They're not carrying it. But the folks who are carrying debt, do we have an idea of whether they're actually making progress and working on this?
You would think there would be, but again, people have gotten themselves into debt for a reason. And I think, again, with the overspending, putting money on credit card, it just boils down to just a lack of simple financial literacy in a lot of cases. People just simply do not know how to create a budget, how to balance a checkbook, how simple interests work, how their credit cards work. I think that's kind of a byproduct of that.
Well, if you are not going to be aware of how it works, you are going to wind up messing around with it, and you're going to find out that it winds up turning out badly. That's what we're seeing here. Chip, great stuff. Thanks so much for joining me again on Money Life.
My pleasure, Chuck, as always.
That's Chip Lupo. He's writer and analyst at Wallet Hub. Go to wallethub.com for more information to get information that'll help you become that good consumer that we're talking about. Follow the direct link in our show notes if you want to find the study we've been talking about there, our 2025 household debt survey. And we'll be back with more of Money Life in just a moment. Stick around.
Did you know that global generalizable robotics represent a $24 trillion investment opportunity? Top robotics and AI companies are actively reshaping industries across sectors. Learn more about capturing this investment opportunity at Vetify.com.
Welcome to the big interview on the August 6th edition of Money Life. And they don't get much bigger than my guest now. Cronk is Chief Investment Officer at Wells Fargo Wealth and Investment Management. You can go to wellsfargo.com to learn more. He's also president of the Wells Fargo Investment Institute. Really interesting investment commentaries and a lot of stuff. If you're looking for regular commentaries, one of the things about Wells Fargo and the Investment Institute, they put out stuff like on every headline you think they're going to be giving you their reaction. So I encourage you, check them out. We have the link in our show notes. Cronk, welcome back to Money Life.
Thanks, Chuck. Great to be here again with you.
Let's start with where we are because you and I haven't talked for a while. But the fact is, as we sit here in August, we've kind of had, if you just closed your eyes, the year that people were expecting. Like the market has been fairly benign. It's been driven by earnings rather than rate cuts, et cetera. You've just had all the craziness if you read the headlines. So benign or crazy, what are we more likely to get moving next?
Probably, we think benign. We hope anyway. The first half was plenty crazy enough. I mean, if you just go through the headlines of, global trade war with Liberation Day, a hot war breaking out between Israel and Iran, bombing nuclear facilities in Iran, right? Just go through all the headlines. You would not have guessed, as we sit here in August, that the major equity indices are sitting almost on their all-time highs, right? After today that we're up about 33% from the April lows. So we've come a long way in a short period of time, about 80 trading days. Hopefully the second half here settles down a little bit as we think about, maybe putting a little more clarity and hopefully some certainty around key elements for markets like the tariff and trade situation, like what's going to happen with the Fed and interest rates. To your good point a few minutes ago, we're finally getting some earnings stability that's helping with price earnings multiples. We're finishing up the second quarter earnings season, and those numbers are coming in at least double, if not almost triple, to what consensus was walking into the earnings season, which is certainly welcome news here as we sit on August 6th today and think about, what we have left in this calendar year.
When you look at all that headline risk, there were things that people in your job, my job, or anybody who's playing the role of economist would have expected to see. And we haven't seen them all yet. Are we going to? I mean, I'm talking things like inflation as a result of tariffs and things along those lines. Are we going to see them? Or is this economy somehow set up to avoid the things that we expect to happen in the conditions we're having?
I don't think it's set up to avoid it completely. And I do think there's a lot of noise that's happening kind of under the surface, if you will, Chuck. I mean, let me just give a couple good examples, right? Certainly, we're seeing what I would call some weaker data coming out of the labor markets, right? We got a non farm payroll report on Friday for the month of July. Economy added 73,000 jobs. Only about 35 of those were from the private sector, and then big revisions for the prior months. It looks like the economy is adding fewer jobs. Now, the good news is there haven't been widespread layoffs, and typically, without deterioration in layoffs, you don't get a recession historically and economically. The other thing I would point to is, when you look at the second quarter first read of US GDP, which came in at a 3%, which by all means is better than most expected, but you kind of unpack that. The data was pretty weak under the surface. Only about 1% of that came from consumer spending, 3/10 from CapEx, negative from housing, flat from government. And what you ended up with was trade contributed a full 5 points and inventory subtracted 3.2 points. So when you get under the surface there, the real economy is growing about 1 to 1.5%, which is not as robust as most people think, right? And I would call it dangerously close to kind of stall speed.
How worried are you that we exceed stall speed? And if we stall, well, using that analogy properly, how much do you fall? After you reach stall speed, you're dropping like a stone to some extent until you regain control. So, I mean, you said you don't expect recession, but that doesn't mean we couldn't see it with the market
Correct.
doing something like that. So, what's the outlook?
The market, from an equity standpoint, can really only grow as fast as earnings will allow you. And let's just unpack that for a second, because remember, first quarter earnings, revenue grew at 7%, earnings grew at 15%, which was one of the best quarters we've seen in a long time. As we sit here in second quarter, you're getting revenue growth of 5 to 6%, with earnings growth around 8 to 9%, right, which is far better, as I alluded to, than people expect. So I think that can help power markets through. The economy, I think, needs probably a little bit of help from monetary policy. We do think the Federal Reserve probably moves to cut interest rates in the month of September. August, as you recall, is a Jackson Hole meeting, so there's not an official Fed meeting. So the next real live meeting is in September. That's what markets are already pricing in. They've got almost 100% certainty as we sit here today that the Fed will cut interest rates in September. And they've got a total of 60 basis points in for fiscal year 25 by the time we get to year end, which basically means another little over one more cut this year. So if earnings stay strong and the Fed gives you some interest rate cuts, I do think the economy avoids a recession, but we're in this kind of soft patch here that we need to reaccelerate out of as we close down 25 and start to look out into 26.
And I mentioned that at Wells Fargo, you guys are really good about sort of doing those reactions and you guys are very clear about your forecasting, et cetera. So I know you're already looking towards forecasts for
Oh, yeah.
26. Are you looking out that far and seeing storm clouds on the horizon like 26 could be the year?
No, actually, we don't. We think the economy reaccelerates mildly into 26. So, like, we've already put out our year-end 26 targets, for example, and we've got a 7,000 midpoint target on the S&P 500, which is nicely up from today. We think the back half of this year is choppy, but we would see earnings on the S&P 500 growing from about, they're tracking about $265 in earnings today, up to 290, which, doing the math, gives you solid earnings growth into next year. And then what I think people miss on some of this, and let me, if you'll indulge me for just a second here, Chuck. So people forget that tariffs, as important as they are, and they are a tax. So somebody pays that tax, whether it's, an exporter exporting to the US, somebody in the supply chain, a company, or the end consumer. They still, at the end of the day, are a one time price reset, or you could call it a one time hit. But what is more of a secular boost that we think starts to really gain legs into 2026 is some of the recently passed US tax bill, previously called the One Big Beautiful Bill, that has full CapEx depreciation covering 80% of capital spending. It has unfolding deregulation around a number of key industries. It has incentives in there for a continuation of kind of the US manufacturing renaissance theme that's been in play for several years. So we think a lot of that starts to give tailwind into markets and into economic growth out into 2026. We just have to weather our way through this soft patch through the back half of 25.
You talked about rate cuts being basically 100% certainty and being priced in when it comes to what the market is expecting for September. But the Fed has proven to be more stubborn on this, and they're still waiting for data. Are you convinced that they're happening now? And how worried are you if they don't happen now that we'll wind up saying they waited too long?
Yeah, I think the Fed, you're correct, right? A couple points there. One is the Fed has been kind of waiting for Godot, if you will, right? Because you could argue the bond market has been screaming at them to cut interest rates. If you look at where the 2 year Treasury yield is today versus where Fed funds is today, there's almost 50 basis points of difference there, right? So it's telling you, the market is telling you, they think short term rates should be lower than where the Fed is holding them at today. And then the question for the Fed is, does the Fed get the data it needs to substantiate those cuts? And if you look at the jobs data, we talked about the weakness there. Just this week, we've gotten some ISM services numbers, which suggest that services, which is the big piece of the US economy, is again kind of weakening down to it. It literally came in at 50.1 yesterday, which is the least reading you can get before the services piece of the economy falls from expansion into contraction. And then I mentioned some of the GDP softness and kind of the underlying growth trend. So I think the Fed's going to look at the body of that evidence and suggest that, yes, now we have the evidence, even if inflation is still looming out there, we have the deterioration kind of in the labor markets and everything else to go ahead and make that September cut. I think the real question is where they go beyond that, right? And what the bond market wants them to do versus what they're willing to do in the last couple of meetings of 25 and out into 2026. The bond market's still pretty aggressive on what it thinks, as I mentioned before, 2+ cuts through year end 25. And if you look out at the futures curve, it's got 5+ cuts in total between now and year end 2026, which is pretty material.
It certainly is. Given everything that we have been seeing, of course, we saw a big rally internationally at the beginning of this year. There are some who think that rally has kind of played much of its way out. There are others who think it's going to continue because the valuations are so compelling internationally. Where are you on international investing right now and the potential impacts that tariff resolution will have on all of that?
Tariffs, we think, are going to be hard on international countries as a whole, and you can see that playing out in the headlines. I guess we were not believers nor buyers of this kind of death of U.S. exceptionalism, and that all the opportunity now was finally going to port its way overseas into international developed economies and international emerging market economies. Head nod to the fact they've done well this year, but we've seen kind of fits and starts where international outperforms domestic, and that usually has about 3 to 6 months of staying power in life, and then the last 7 times we've gone back and looked at when international has outperformed domestic, it tends to fade and roll itself over. I think the real key there is what happens with the US dollar. Now, there are some that would say the US dollar is going to weaken another 10% from where it is today. If that's the case, then international should absolutely outperform US and domestic. That's not our base case. We think the dollar stabilizes here, and if anything, probably regains a little bit of the 10 to 11% deterioration it's seen, which probably resets that playing field. So we're still very much favoring US over international as we think about the back half of 25 and into 26.
I am not calling you old when I say that you are experienced and you've been watching markets for a long time. The question I normally have been asking has been more about, do these conditions remind you of something from your past or anything even that you might look at history? And typically we then get it broken down into, well, I remember higher inflation periods or what have you. So I want to change that question up. Is there anything in your experience, et cetera, that leads you to feel that these times are realistically the same, that we haven't seen some fundamental changes that while they're not, this time is fully different.
Mhm.
We haven't been through too many stretches in an investing lifetime of a number of years or decades that says, yeah, you can have the 3 big years in a row and look out and not expect some big correction or big decline. You can be sitting here expecting more to happen without the inflation of a bubble and all of the other sorts of things. Is there some fundamental change in the economy or in the way business is done that maybe is going to mean we don't see the kinds of recessions? We see rolling recessions or things like that, but that we don't see all the things we classically think must happen.
Yeah, it's a really good point. It's a hard one to unpack in all candor, right? What people forget is the US economy hasn't had a recession, a true recession, since literally the 2008, 2009 global financial crisis. Now, before somebody jumps on me, in fairness, the NEBR declared a 2-month recession when we closed down the economy around COVID, right, in the pandemic. But that was literally 2 months, right? And it was not driven by economic forces in the cycle. It was driven by us choosing to close down out of necessity and need because of the global pandemic. So we've gone now 15, 16, 17 years without any type of an economic recession in a normal cycle. I think what is skewing everything, and this is known well, let me just put two fine points on it. One is you now have the 10 largest S&P 500 weights by market cap are just under 40% of the index, which is unparalleled. In fact, if you go back and look, you can't find another period of time where the top 10 names, even during times like the Nifty 50 and stuff, have dominated at that percentage level of a market cap weighted index. So you have to be thoughtful about how you manage that, how you control the concentration risk in the portfolio and across the indices. It may mean a little bit of a tilt more towards active management that you can control those weightings than just passively buying, the ETF at the next dollar on. What is important though is if you look at the earnings growth of those companies, it's just dominating. We talked earlier about the earnings growth. If I took just the four largest of those, the earnings growth this quarter has been 29% for those companies, tech companies, and the rest of the entire index is 2%. So it shows you the dispersion between and across sectors of where growth resides and where growth is coming from, right? So you have to think about that in your managing portfolios and where you want to make sure that you're not getting yourself out over your risk skis, if you will, from both a concentration, but you're also being keen to understand where that growth can give your portfolio the lift it needs.
Daryl, last question in limited time. It has been very hard for investors to separate the hard and the soft data. The soft data says we
Yeah.
hate what's going on, we dislike inflation, et cetera. The hard data says everything is good. Given that your forecast gets back to that benign that we started at, is there a reason to believe, at some point the worries must show up? Or the investors who are going to benefit the most here are the ones who are able to overcome and then climb that wall of worry? That, in other words, watch the hard data, ignore the soft.
I think the latter, right? I mean, the soft data has sent not just recently, but over and through this cycle, many false positives that if you would have simply managed believing that the soft data ever and always leads the hard data, you would have made bad portfolio decisions. And I think this is another example. In fact, what's actually happening right now, kind of in real time, is the soft data because of what's happening with the stock market and good returns and home prices and the wealth effect are still up. It's all leading to that soft data actually making a turn and starting to come higher, even as the hard data, as we talked about earlier, is kind of rolling over a little bit. I would fade that. I think you need to still stay disciplined about your portfolio. Don't let some of those emotions take over as people typically do when they see ghosts and start fearing things that just may not happen or be there. It'll cause you to make bad portfolio decisions, and we've seen that time and time again. So be disciplined, right? Where your allocations get out of whack, make sure that you rebalance those and bring them back to some strategic targets. But don't exit the market and don't sit on too much cash in this type of environment, because we think there's some good things coming in 2026.
Daryl, great stuff. Always is when we get a chance to connect. I really appreciate it. We'll talk again probably in about 6 months. So we'll be looking at how 2026 is starting to shape up. But thanks so much for your time today on Money Life.
My pleasure, Chuck. Thank you.
That's Daryl Cronk, Chief Investment Officer at Wells Fargo Wealth and Investment Management, President of the Wells Fargo Investment Institute. WellsFargo.com for more information. The direct link to the Investment Institute in our show notes as well. And up next on Money Life, we're talking equity income investing with Jenny Harrington, portfolio manager at Gilman Hill Asset Management. It's market call time when we come back in just a moment. Jenny Harrington, Chief Executive Officer and Portfolio Manager at Gilman Hill Asset Management is here. We're talking equity income investing, and it's market call time. Welcome to the Money Life Market Call, the part of the show where we talk with experienced money managers about how they do their job, what they look for that determines their buys and sells, what they see happening broadly on the market, and how they put it all together. And we know you love hearing from new and different sources. Well, today, making her debut on the show, Jenny Harrington, Chief Executive Officer, Portfolio Manager for Gilman Hill Asset Management, also the author of Dividend Investing, Dependable Income to Navigate All Market Environments, which came out this spring. And I will apologize to her up front, but also to you in the audience, because we have rules on Money Life about how quickly we are supposed to be talking about a new book. Like, we don't talk about books that have been out for too long. And I had a copy of Jenny's book and I blew it. So we didn't do an interview about the book. But again, it's Dividend Investing, Dependable Income to Navigate All Market Environments. And you will get a sense of what she's talking about. And if you are looking for a primer on dividend investing, you might want to check it out. You'll want to check it out, GilmanHill.com, the website for Gilman Hill Asset Management, and Jenny Harrington. Jenny Harrington, welcome to Money Life.
Thank you so much for having me. I'm excited to be here.
We always start with methodology. Obviously, with the book, my audience can figure out you are a dividend investor, but that means different things to different people. So what does it mean to you, and explain what it is that you go in looking for?
So specifically, I am a dividend income investor, which is very different than a dividend growth investor. A dividend income investor is a portfolio that looks for stocks that create a high dividend yield. So you can have companies like Apple, Microsoft, even Nvidia that pay a dividend, and those dividends grow, but they're minute. The yields when you own those stocks are 0.01, 0.1%. They're nothing. It doesn't create an income stream. When you're a dividend income investor, you're saying, okay, let's say I've got $1,000,000 or $100,000. Let's put together a pile of companies that can create an income stream of $5,000 a year, $50,000 a year. So you're seeking out companies that have a high dividend yield, maybe a 3%, 4%, 5% plus dividend yield. And those tend to not be the hot, exciting stocks that all of the financial pundits like to talk about. They're boring. They're companies like Energy Transfer Partners and Crown Castle and Pfizer. They're old, mature, high free cash flow companies where they know they're not going to be able to give their shareholders a lot of growth, but they can give them really consistent dividend income. Chuck, I want to pull back on something that you said just to start. I don't think you owe your listeners an apology for being late with this. I think you should say to them, "You're welcome." Because if they'd bought this book in April and taken 2 weeks to read it and then invested in dividend stocks versus the S&P 500, they'd basically be flat right now. Whereas the S&P 500 since the middle of April is up significantly. So I think you should say to your listeners, you're welcome for this excellent timing. With the broader market being up so much, if you say wanted to rebalance, now might be a very good time because you have a real performance gap right now that wasn't there to this degree 3 and change months ago. So I think you're doing everyone a favor.
Well, whenever they find out about it, we know that they like dividend investing and they like equity income investing, I want to ask a question that's a little off the beaten path of the standard market call, which is because you are looking at those higher income streams, because that matters to you, there are all sorts of tools that have been created. We've got an audience that is interested in things like closed end funds, but now you've got all of these options oriented ETFs that are looking at like, let's go off and buy an income oriented version of the Qs or the SPY or whatever it might be. And I'm curious, does that change your toolbox and how much, because you've been doing it for a while, et cetera, do you want to stay with stocks? How much of it is wait, right tool for the job? Like, do you use those other things and do you recommend them
I don't.
or okay, you don't. So why not?
I neither recommend them nor do I use them, but that's just specific to the way I manage a portfolio. So I manage a portfolio in a pretty old school way, which is to say, let's put together 30 to 40 stocks. Let's have the total portfolio have a 5% or better dividend yield. And let's just take that income. And you can do whatever you want with it. You can reinvest it, you can, spend it, whatever you want. But we don't use derivatives. And we don't use any portfolio hedging tools. We don't use any funds. So I don't, and that's just how we manage. We're like the fund manager, but it's in individual strategies. So plenty of people do, and they do it successfully. It's just not where my expertise is. One of the things along the line of using derivatives and hedging strategies for your portfolio that I've been thinking about a lot is risk and risk management. And I think there's a lot of technical ways to manage risk in a portfolio, but the older I've gotten, I think the most important way to manage risk is through behavior. And one of the really nice things about the portfolio that I manage is when you're in a March of 2020 or the great financial crisis or even this past April, you are able to go to your clients and say, "Hey, your income's safe." If you were getting 50,000 a year, you're still getting 50,000 a year. Just because the market's going haywire doesn't mean these companies businesses are significantly impacted and they're still paying out the dividends. But then because it's an individual stock portfolio, and by the way, what I'm about to say appeals to some people and really doesn't work for others. But for some people to be able to look through that portfolio and say, I own companies that I know. I'm calling you from my Verizon cell phone right now. I'm taking medication from Pfizer. I just got a package delivered from UPS. To know the companies in the portfolio and know that when times are tough, you're still using their services, that all adds to the good behavior, which I think is the biggest risk mitigator, is just don't be a dummy in March of 2020 or April of 2025.
And that actually brings me right to what the next question was going to be, because as we talk about dividend investing, March of 2020, as we got into COVID, became an important time, not just because of what was happening on the market, but for dividend stocks. You had a bunch of dividend achievers and the companies that have long term dividend track records that wound up not raising, cutting, halting, what have you. How did that change the dividend landscape? Did it, make it that it's forever changed or just okay?
Nope, it didn't change it at all. And this is the crazy thing. So I think it was like March 31st, 2020, maybe a little bit after that, but Goldman put out this report that essentially declared the death of dividends. 6 months later, they put out a report regaling the greatness of dividends. And if you go back and look at the amount of dividends that have been paid out by S&P 500 companies, it was at an all-time peak this year. It was, I think, $620 billion paid out of S&P 500 companies, up about 6 or 7% from 2023. Sorry, this year being 2024, so the most recent year. The dividend income paid out by S&P 500 companies has just grown and grown and grown. So March of 2020 was a momentary kind of, fluke. I'll give you a great example, actually. Do you want a company specific example or want me to save it?
Sure.
This is perfect. I think you asked me, hey, maybe we'll talk about some good ideas. And one of the stocks in my portfolio is Ryman Hospitality Properties. The ticker is RHP. And they own things like oh, you like concerts? They own the Opryland Hotel. They own the Grand Ole Opry and the Ryman Auditorium, and they own 5 of the largest non-gaming conference centers. This is a stock that I'd owned, probably from 2017 or 18 through 2020. They did cut their dividend. They had to. They did not want to. And when I bought it initially, I could go back and look at the great financial crisis, say, "Hey, let's stress test this and see what happens in a horrible market." Dividend should have been fine, stock should have been fine. Pandemic was completely different. All of a sudden, they lose all their bookings. And they said to shareholders, we have to cut the dividend. We're so sorry. We will reinstate it as soon as we can. Guess what? 5 years later, I was able to buy it back this year. It's got a 5% yield right now on August 5th. It's trading at a reasonable multiple of about 10 times funds from operations. It's a real estate investment trust. Great valuation, great yield. They brought that dividend back as fast as they could. I think that's a good example, frankly, of almost the worst of what the fallout of the pandemic was. I had another one, Sabra Healthcare, another real estate investment trust that's in the skilled nursing retirement home space. They slightly trimmed it and said, we'll get that dividend back as fast as we can. And they did. But most of the portfolio, Chuck, most of the portfolio during those darkest times, the dividend stayed completely intact throughout. We had like IBM and what do we have back then? Verizon and trying to think what was in it, Pfizer back then. With all Pfizer's stock trouble, the dividends never been cut. So, yeah, so most of the income stayed intact. And I liken it, and I talk about this in the book, I liken it to running a business with 30 employees. Inevitably, someone's going to quit on you each year. You just replace them. There's always someone to replace them with.
So, what is the sell methodology for you? Is it how much is it? And in that, I want you to answer another question that comes up a lot, which is how much of it is current yield? Because of course, if you say, "Oh, I'm putting in, $10,000 into a stock that is currently yielding 5%," if the stock doubles, the current yield on the stock is 2.5, but your 10,000, it's still getting paid that 5% that you put into it. So, how much does that factor in for people like, hey, if I'm getting capital appreciation, I'm willing the yield I started with, maybe less than the current yield, but it's still my yield.
So, this is a huge downside to being a portfolio manager versus an individual investor. If you are an individual investor and you buy a stock with a 5% yield and you put $10,000 in and that yield grows and grows and grows, but the stock price grows more, you know what? You can probably hold that forever. As a portfolio manager who has a comprehensive portfolio that always has cash flows coming in, and on average, the yield of my portfolio needs to stay at 5% or better. Frequently, when the stock gets too expensive, I need to sell it. So here's the perfect example, IBM. I sold IBM earlier this year. Okay, first of all, I bought IBM way back. I think we paid under $100 a share for it. Nice 5% yield. I had to sell it earlier this year. We sold it around 220. The yield was about 3%. It's now at 250, and it's part of just sticking to the discipline. And that cuts both ways. So I think if you're an individual, the current yield matters less versus your yield on inception. If you're a portfolio manager who's managing for multiple portfolios in a big collective strategy, you have more kind of current yield sensitivity. But there's also an upside, which is the most important part of investing overall is discipline. And to some large degree, when a high income oriented company like an IBM or like a Verizon, when the yield starts to shrink, frequently it's telling you something else too, which is, hey, the valuation might be a little rich. And a lot of times that works for me. So another one, so IBM worked against me, right? Because it's up about 10+% since I sold it. One that worked for me was I sold SL Green earlier in the year. And SL Green is a New York City office real estate investment trust. And their share price was in the high 60s. Yield was well below 5. It didn't make sense for that. I thought this valuation is too rich. We sold it now. It's at $54 a share. And so the forced discipline can cut both ways is the answer. But if you're an individual and you can look at your yield on inception, it's a beautiful thing.
You've given us some examples, but is there one that is really the poster child? Because the examples kind of came up conversationally. They were not like, here's the stock that, if I was telling you out of the book methodology would lead you to right now say, this is the ideal stock.
All right, you want a poster child? Here's the poster child for here and now. Vici. The ticker is VICI. And it's another real estate investment trust. And I don't mean to harp so much on these. They're just good stories to tell that everyone can understand easily. But what they do is they own large casinos. So like the Venetian and the MGM. They also own smaller regional casinos and they also own Bowlmores. They have A plus tenants, and so they own the casino, but their tenants are things like Caesars and MGM. So you go through a time like the pandemic, and I love using the pandemic as a stress test because it was so messed up. They have 100% occupancy. They have 100% collection. But the reason I haven't bought it for the past 3 years is because they also have modest earnings growth, funds from operation growth. Maybe they have 3 to 6% growth. They have maybe a 5 and change dividend yield. All in, I think I'm going to get 8%. That didn't make sense in the raw growth environment of the past couple years. But in the environment that we're in now, where I think growth is going to be a lot harder to come by, the surety of that 5.5-ish yield plus a very visible 3% earnings growth, that really works for me. So that's my poster child for the here and now today.
Now we're going to get your quick and dirty take on some stocks that my audience is particularly interested in.
Quick and dirty.
Shall we play a game?
Oh, absolutely. And the game we are playing, well, as we always like to say, this game gets you ready for the real thing. Quick and dirty is our lightning round. It's where we put our guests to your test. And today we are testing Jenny Harrington. She is portfolio manager and chief executive officer at Gilman Hill Asset Management, author of Dividend Investing, Dependable Income to Navigate All Market Environments. Learn more at gilmanhill.com. You know how quick and dirty works. We're a little late getting here, so we're going to jump straight in, starting with a request from Laura in San Antonio, Texas, for Star Bulk Carriers Corp. It is SBLK.
Star Bulk's been amazing. 100% return just on the income over the last few years in our portfolio, but it's now a source of funds. That means if I need to buy something, this will be the thing that gets sold. Why? Because they've basically taken the dividend yield way down, almost nothing. They might bring it back, but for me, I need a high dividend yield right now. Great company, great set of assets, but I need more yield.
And now for the profit taking.
Yeah, profit taking is not a problem. It's a good thing, and you've had profits to speak of, but you're maybe moving away from SBLK, Star Bulk Carriers. Richard in Chula Vista, California is in on our next two requests. He shares the first one with Lance in Bethlehem, Pennsylvania, wanting to know about One Oak, its ticker OKE.
Here's another take the profits. I owned this for a long time and I sold it at the beginning of the year this year at about $100 a share. They're in the midstream energy space, fantastic company, but they went on too much of a buying spree. And with all of the awareness of how much energy and power generation the US is going to need, that stock was up like 60% last year, I think almost the same the year before. I took some off the table. But interestingly, just now, I'm thinking, maybe I need to look at it again. The yield's back up to 5.5%. So took money off the table. And just like I went back into Ryman once upon a time, I might get back into this. I'm not there yet.
Don't get greedy.
Well, that's why you needed to sell. You didn't want to get greedy on One Oak OKE, but again, it's now on the watch list. So hold it if you've got it, but you're waiting for a better entry point on One Oak. Richard joins Greg in Tully, New York for our next request. It's SWKS, Skyworks Solutions.
So we're getting all the ones I sold. So this was a huge mistake. This was in our disciplined growth strategy, actually. And we bought it at 121 2 years ago, sold it around here in February. Now it's got a hefty dividend yield. And I said to my colleague, Greg, I said, Greg, does it make sense for the dividend income strategy? His response was, only if you really like a management team that consistently misses earnings and screws you over every time. I wouldn't touch it.
So the words you used were?
Big mistake.
Yeah, that's a sell or an avoid on SWKS, Skyworks Solutions. Robert in southeastern Massachusetts, not too far away from me, and Dave in Jacksonville, Florida, both want to know about Ventas. That's VTR.
All right, finally, something I love, another real estate investment trust. This is something that kind of crosses between our disciplined growth strategy and our equity income strategy. So it is an extremely well-run healthcare REIT. They also focus in that retirement skilled nursing segment. It's got just about a 3% dividend yield. And the reason the yield's so low is because the stock has done so well, but it is an excellent management team. There's significant growth ahead. You get a really nice, consistent growing dividend yield. Love this stock.
I just fell in love.
Well, Jenny Harrington loves it. You might love it too. Ventas, VTR, is a buy. And last, for Amy in San Diego and Jeff in San Jose, it's Lyondell Basel Industries, LYB.
So here's another one that I actually love. And you're going to look at the chart and say, oh my God, that's so ugly. How can you love it? It's in the plastics business. It's very well run, very well managed, excellent balance sheet. I actually recently sold Dow, DOW, which is in the same spot, to swap into Lyondell Basel. They raised their dividend last quarter. They're in terrific shape. It is very cyclical, and I think this is the bottom of the cycle. So what they need is they need oil and gas prices to work in their favor, which is tough. Once they start doing that, the business improves. In the meantime, you're getting a hefty 11% dividend yield, talking about, returns on inception. You're gonna with 11%, you CAGR that out, the stock can stay flat for the next 7 years, and you'll double your money.
Yeah, so we finish on a high note with a stock that has been striking low notes but has that potential.
It's hit rock bottom. Come on, let's buy.
Yep, that's a buy on LYB, Lyondell Basel Industries. And speaking of good buys, we've come to the point where we need to say our goodbyes to Jenny Harrington. But Jenny, this was great. Thanks so much for joining me. Let's do this again down the line.
Would love to. Thank you so much for having me.
Jenny Harrington is Chief Executive Officer and Portfolio Manager at Gilman Hill Asset Management, the author of Dividend Investing, Dependable Income to Navigate All Market Environments, which came out this spring. Learn more about her, the firm, and the book at gilmanhill.com. And learn more about where she agreed or disagreed with some recent guests as we cross the finish line on this show right after this message.
Asset managers, you know how hard it is to stand out in this crowded space. VettaFi is a unique partner that can help you across the entire product lifecycle. With a best-in-class index factory and an award-winning digital marketing team, VettaFi can help you build the products of your dreams, optimize your distribution efforts, and grow your assets under management. Learn more at VettaFi.com.
We are back to wrap things up. I hope you enjoyed that interview with Jenny Harrington. Let me know. I always like to know when we bring in somebody that you haven't necessarily heard from before, that you like the extra opinions, etc. And again, her book, well, we should have been talking about it when she released it. Could have done a contest, all those other things. There was not a lot of crossover. I do want to point out that before we got to what do you really like, she did mention Energy Transfer Partners and Crown Castle and Pfizer as the kind of things you want to own, but they were not really her picks. And she didn't say specifically, I'm loving these now. She just talked about how they're the kind of things you want to own for the long haul. And she made it pretty clear that she does own them. So I'm not crossing them over. But as for everything else, well, there were two. One was IBM, which she talked about having sold. And Garvin J. Bush from Green Alpha Advisors on July the 11th said it was a buy. And he specifically said it was a sleeper play in AI. He said, basically everybody thinks IBM is the old stodgy company. Most of that's been sold. And what they are is like a sleeper AI company. So that was his case for buying it. But again, because that case would be very different from the dividend investing, you can understand why the two of them might have disagreed. That's why we give you crossover. So you can say, which side do I want to lean into or lean out of? Then you had Skyworks Solutions. It was an avoid today. Wayne Thorpe, the head of research and analysis products at AAII, was selling it back on April the 1st, and he was not being an April Fool about it. Tomorrow on this show, Jurrien Timmer, Director of Global Macro at Fidelity Investments. Does not get much better than that, but we'll make it better by adding more around it and to it. But I'm super excited. It's definitely going to be a day you don't want to miss. Of course, we say that about every day. Now, also, we say every day that you should have something to celebrate. And today, well, there's one that I'm really interested in.
Baby, you're the greatest.
Well, I'm hoping that the baby that's coming into my life will be the greatest because my daughter Whitney is pregnant and due in 8 days is her due date, actually. But today is Corporate Baby Name Day. As if you're going to give your baby, say, Snapchat, Netflix, etc., in honor of the idea of selling the naming rights. Now, there's a commercial right now that talks about this. But in 2001, so long before the commercial, American Baby conducted a poll asking if parents would sell the naming rights to their babies for $500,000. And some of the corporate names that were listed as examples were Pepsi, Friskies, Kleenex, Budweiser, and Jeep. And 21% of respondents said they would. 28% more said they would consider it. So almost half of the people said they would at least think about it, if not do it. The results of that poll in 2001 were released on August 6th, which is why today is Corporate Baby Name Day.
There's only one right one, baby. You got the right one, baby.
Yeah, there will be one right name. It probably will not be Pepsi. Yeah, I'm just saying. Today is also Hiroshima Day. It's the anniversary of the day that the United States dropped an atomic bomb on the city of Hiroshima, or Hiroshima, however you want to pronounce it, during World War II. It can be a day to remember and very solemn, or it can be a day to say no nukes. Whichever it is, it's still worth noting that it's happening on the calendar. It's also Farm Workers Appreciation Day, National Fresh Breath Day. I would hope that every day was Fresh Breath Day.
What reeks?
Hopefully not my breath. It is National Wiggle Your Toes Day, and on the food front, it is National Root Beer Float Day. My guests today were Chip Lupo, analyst at Wallet Hub. It's wallethub.com. Direct link to their household debt survey is in our show notes. Daryl Cronk, Chief Investment Officer at Wells Fargo Wealth and Investment Management, which is wellsfargo.com. Wells Fargo Investment Institute. You can get their analysis. We have a direct link. It's a much longer link at wellsfargoadvisors.com that is in our show notes. And then Jenny Harrington, Chief Executive Officer and Portfolio Manager at Gilman Hill Asset Management, online at gilmanhill.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Jane Austen, who said, "A large income is the best recipe for happiness I ever heard of." Well, I don't know that it's the best recipe for happiness, but a large income certainly gets you to happier, at least than we were saying about in yesterday's quote. And it helps you keep things in perspective, so keep them in perspective. And remember, until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great day, everybody. We'll see you here again on Money Life tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Have a nice life. What's left of it.